You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The futures markets can be downright scary. Limit up, limit down. What the heck is RBOB anyway? Are they going to dump a truckload of soybeans on your front lawn if you click the wrong button? Come to think of it, maybe you should just stick to your comfort zone. Or you can break out of it with the Futures Rundown. The Futures Rundown is here to help you make sense of these scary markets. We'll analyze all the top futures trading activity, explore the ins and outs of your favorite products, explain exactly how futures work, and hear from leading experts in the futures markets. We'll even tackle all of your wildest futures trading questions. If it involves futures, then you'll hear about it on the Futures Rundown. The Futures Rundown is brought to you by T4 Futures and Options. Elevate your trading experience with the T4 Futures and Options trading platform. Whether you prefer desktop or mobile applications, T4 delivers low latency and professional grade functionality for both traders and brokers. Take advantage of theoretical sheets, strategy solver, MBO, advanced charts, and a suite of powerful features to enhance your trading strategy. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. And now, it's time to break into the futures markets. It's time for the Futures Rundown.
All right, everybody. That music means we are back. It is Wednesday. Time to roll out the latest edition, the one everybody seems to be loving. Glad to see the response has been so strong. We're a month and change in now. This is episode 7. Crazy, crazy. Time flies when you're adding new shows to the network. 17 and a half years in and still growing strong and indeed growing. Again, glad to see so many of you folks are enjoying the new show. You are the reason we launched this stuff after all. So keep that feedback, keep those questions, keep those listens and downloads coming. That really does help fuel the show going forward. And of course, if you want to go forward into some more great content, A, you should be listening to the full network, not just the Futures Rundown. And B, if you want to go above and beyond, head on over to theoptionsinsider.com/pro to learn more about all the great pro exclusive content we have floating around over there as we go out to see who's joining us on the old Futures Rundown this week. I'm pleased to welcome on a first-timer on the program. He is Brett Friedman, the managing partner at Winhall Risk Analytics and a contributor over there at OptionMetrics. Brett, welcome to the Futures Rundown program.
Thank you for having me.
And Brett, as we are wont to do with all of our first-timers here on the program, why don't you go ahead and give our audience a bit of an overview of your background in the world of futures, as well as what it is you do at Winhall Risk Analytics.
I think unlike most of your guest speakers, I began my career trading foreign exchange options. So I began in options and then after that moved into futures, which I think is a little unique. After foreign exchange options, I was a market maker. I moved into energy options and crude oil as well as all the products. So we traded futures as well as options. After that, I moved into power for a while and then started my own risk advisory firm after spending a stint at Osprey Management, where I was the chief risk officer. which at the time was the largest commodities hedge fund in the world. So if someone had to ask me, I'm a futures and options guy, but basically I'm a commodity guy. Some people say they're stock guys. Some guys say they're fixed income guys. I'm a commodity guy, and I have been for my whole career.
Power markets, those are pretty wild. We'll have to devote a whole show to those coming down the road because a lot of wild stuff going on there. But first, listeners, let's kick things off the way we are wont to do. It is time to enter the trading pit.
It's time to break down all the action that's lighting up the futures markets this week. What's limit up and what's crashing and burning? Let's find out. It's time to enter the trading pit.
All right, everybody, welcome to the trading pit where we break down all the things that are lighting it up in the green and in the red out there this week. We have a lot to break down, a kind of a broad cross-section lighting it up this week, including some interesting surprises. But before we get to all that fun, Brett, as our guest, I will start with you, sir. You said you're an old school commodities guy. What's catching your eye out there in the futures markets this week?
The same thing that's been catching my eye for the last month or so, and that's crude oil WTI as well as Brent. With everything that's been going on in the Mideast, I mean, if someone told me, if I were a Martian and just landed on the planet and told me that there's several wars going on in the Middle East that could affect supply, and year to date is down almost 2% in crude oil and almost 4% in Brent, I'd say you're absolutely crazy. But that is the situation, which indicates to me the geopolitical light goes on and it goes off. It was on last week and now it's off again. And so they start focusing on supply. But with all the geopolitical stuff going on, you know, with crude oil trading $70, Brent $74 and change, you know, is this the best you got on the geopolitical stuff? I would be easily expecting, with everything that's been going on in the Middle East, with the Houthis and the shipping issues, et cetera, possible supply constraints, you know, that $100 or $100 plus would be in the cards. But apparently it's not. Crude oil traders have decided that the geopolitics is back in its box for the time being.
Yeah, you're right. That is pretty wild when you say it, you know, just out of context like that. If you just said, hey, you know, this year we're going to see all this political unrest, potentially widening conflict in the Middle East, all the things that have in the past led to, you're right, a lot of upside in the crude oil market. And it would give us a blip for a couple of weeks, maybe not even that long. And then we're right back down to threatening the 70 handle again in WTI and other similar levels and other energy products out there. You're right. It is kind of crazy when you say it out loud in that context, because at any moment, this conflict, let's hope it doesn't, but at any moment, this conflict could spiral out of control again. We do have the Israelis planning to make some sort of reprisal against Iran. They supposedly have given their agreement to Washington that they're not going to target any energy or, you know, nuclear infrastructure. So that maybe is quelling some of the fears in the crude oil market. But you're right. It does seem like they're pinning a lot of hopes on that coming to pass and going smoothly there, Brett, where you've been watching these markets for a while. It sounds like, you know, this has been a debate point on the show pretty much ever since it launched a month and a half ago. What the heck's going on with crude? Where is it headed? It dipped into the mid 60s for a while. Some people started saying, well, if it keeps getting lower, if it breaks below, let's say 65 in WTI, for example, then maybe look out below. We're heading for another period of pretty cheap crude oil. And then if it reverts, then maybe we have some more upside. It sounds like if I was going to put a gun to your head right now, Brett, and said, hey, buy the futures, or are you going to sell them? Or in the case of the options, you're going to buy maybe the 70s or buy the 65 puts. It sounds like you'd be leaning to the upside, Brett.
For the time being, down here, this is traditionally, I mean, for the last couple of weeks, it's been sort of almost the bottom of the range. And then the geopolitics comes back in, and then they rally it. Nothing happens, and it comes back off. The issue is over the course of something has to happen to actually affect supply. And I mean actually affect supply, not potentially affect supply. So far, nothing has happened. So it's been on the verge for a little too long. So, you know, the energy markets are essentially crying wolf. You know, it's like, okay, when is this actually going to happen? Something that's gone under the radar, however, crude oil and Brent kind of like take center stage. Natural gas, I mean, is off almost what is it right now? 4.7% today, 238. Natural gas is not performing. It's oversupplied and basically, is fairly bearish in my opinion. So that's kind of like the unspoken thing going on here. Is the petroleum is taking center stage.
You're right. Nat gas, they're coming for it as well. It was threatening $3 again. People thought maybe we're going to break out to the upside, and you're right back down, cutting the legs out from under it, which gets to our winners and losers. I know some people take umbrage at that because you could win to the dark side. We can call them red and green if you want, listeners. Whatever floats your boat out there at the end of the day. We'll stick with winners and losers for now. We can always play with that on future episodes. We'll do a quick top 10 to the upside, then go to the dark side, listen. We'll keep things positive. Number 10 on the week, what's gaining this week? We've got coffee, the Dees coffee contract up about almost 3.25%. Number 9, we've got silver again. This is pretty much all Dees with the exception of a couple here. Silver up 3.83%, the Dees contract again. So our pal Uncle Mike will be quite excited. And then we got the RUT behind it, the E-mini Russell 2000, again December, up 3.93%. So a good week for small caps out there. Equities have kind of been melting up again this week, with the exception of obviously yesterday. Then we got cocoa. This one's been on our list for a while. The Dees contract in cocoa as well, up 4.52% this week. Then we're jumping to the precious, in particular platinum, and all the way out to January, a little bit longer term. The platinum January contract up 4.62% this week. Then we're going out to OJ. That's kind of interesting. We don't talk about that too often. And the November contract, a little more near dated, that's up 5.6% this week. And then we're going out to the land of crypto. In fact, the rest of our top 5 is pretty much all crypto all the time. We got the Ether Micro Oct contract, listeners, up 7.84%. Same for the big Ether futures out there, also October. Bitcoin, the big future and the micro, both up over 11% this week, 11.08% and 11.09%, respectively. Brett, anything catching your eye in that list of upside movers this week, sir?
Cocoa's been incredibly volatile since about 6 months ago when it made new highs. So no shock there. I mean, basically the softs have been one of the big, the most volatile part of the commodity complex since the beginning of the year. So no big shock there. OJ, which honestly I don't follow all that much. It's just generally a reaction to Hurricane Milton because Hurricane Milton went right through the major growing section in Florida, albeit, over 70% of orange juice liquid comes from Brazil, not Florida. So Florida sort of brings up the marginal supply. But the thing with OJ that I'd be careful about is that similar to gasoline, there's a demand response. Over $4.50 a half gallon of orange juice, a lot of people start leaving it off their list. So you're going to get a demand-driven response eventually. Not just, I'm going to buy this no matter what is going on. So I would be cautious about buying orange juice. I'd be cautious about playing in that market anyway, since there's hardly any volume. And OJ is one of those commodities that gets a lot more attention than it really should merit, since it's a fairly minor contract.
You know why, of course, trading places. It'll always be in our hearts because of trading places here, Brett. In fact, I think we'll need to do an episode about good old OJ, just for old time's sake, just to break down that contract, listeners.
OJ pork bellies.
Yes.
And the mothers that are, and constantly in the news. And it just frustrates me because they're just, no one trades these things. These are industrial commodities. They're not, retail or institutional commodities.
Turn those machines back on. Who could forget? Who could forget that movie, listeners? We go to the dark side now, a.k.a. what's lighting up to the red. Number 10 this week, we got hard red wheat out in December, off about 3.5%. Number 9, soybeans, a little bit closer to home in November, off 3.68%. Then our old pal, crude oil. This is what we were just talking about, this surprising downside here in the energy complex. Crude oil, NOVE contract, off 3.85%. All right, behind it, we've got corn, 3.86%. Keeping it in the ags, we go to spring wheat again. The December contract off 4.13%. Then we get to our bottom 5 here, listeners. Let's go out to Midwest Steel. Dees contract, don't talk about that too often here. Off 4.18%. Then we're going out to our old pal, the old NY Harbor contract. Dees contract as well. Off 4.3% to be precise. Then we're getting to lithium. Lithium, intriguing, off 4.35%. The Jan lithium contract coming in at number 3. Number 2, going back out to ethanol, the Nove contract off about 5.5%. Remember when ethanol was going to be the salvation to all of our problems, listeners? Seems like a lifetime ago now. And then number 1 to the dark side, as Brett was just alluding to, natural gas off an even 10% this week. So if you were like us, lamenting at the top of the show all this tumult in the energy space, and yet we're seeing pretty much naught but red on the screen, and nat gas number 1 off 10%, crude oil coming in at number 8 off 3, nearly 4%. We got other contracts in there as well. If you want to throw ethanol in that mix, you can. So yeah, for all this tumult we were just talking about, Brett, it does seem like they can't find a bid this week across the energy complex. What are your thoughts?
Well, not just the energy complex. I mean, the other ones that you just mentioned are basically the same fundamental, only related to the war in Ukraine, which unfortunately is kind of doesn't get that much press, or it's kind of in the everybody's yeah, we know category. Again, when that war broke out in 22, I believe, February 22, there was widespread predictions that we were going to get shortages in certain ags because they're a major producer of corn and wheat. Nothing ever happened. And again, it's the same thing. Eventually, if you keep on saying that there's going to be supply constraints, there better be some supply constraints eventually. Otherwise, the market starts coming off if they just don't believe it anymore. And there we are. The other one you mentioned, that's that fundamental. The other one that's sort of similar, sort of in my same jeopardy category, is lithium. I mean, lithium is off, I think it's about 57% over a one-year basis. And that kind of reflects, the massive oversupply of electric vehicles and the massive over-optimism in that sector. So people basically got way ahead of their skis, and lithium is just, as a mess as a result.
Yeah, let's keep rolling out here, listeners, see what's lighting it up today in terms of volume. Let's do a quick top 10 out here. These are all going to be DEES contracts with the exception of one. So DEES, even though everyone's obsessed with near-dated, the DEES contract is where the action is today. Number 10 is the Ultra T-Bond, so it's kicking things off in the rates, 173,000 of those on the tape. Number 9, we're going out to the ags, in particular the beans. And this is the only Nove contract on the list today, the top 10. It's the Nove soybean contract. 182,000 of those on the tape. Everything else, all DEES all the time, listeners. Number 8, back to the rates. 3-month SOFR. We're just talking about that on TWIFO last week with our pal Dr. Vix out there. An intriguing conversation. Talk about a product that just has paper and volume for days. It's almost impenetrable to the layman to go look at. It was over 8 million contracts on the option side last week. So just a beast. It trades in strips and packs and bundles, all different colors. It's a crazy contract. Coming in number 8 today, the DEES contract, 194,000 of those on the tape on the futures side. Number 7, keeping it in the rates, is 30-year, a T-bond, 245,000 of those. Number 6, off to the equities we go. It's the NASDAQ 100 E-mini, 290,000 on the tape. Number 5, it is back to the rates, the Ultra 10-year, 297,000 on the tape. Number 4, keeping it in the rates. I see a theme here, listeners. It's the 2-year, 349,000 on the tape. Number 3, back to the equities. It's the S&P E-mini, 532,000 contracts on the tape. By the way, if we kept the micros in this list, we did pull the micros out because that's kind of a cheat. They're always making their way into the top 10, but that's a much smaller contract. That would actually be number 4 at 525,000 for the S&P micro. So it'd be back-to-back S&P. Number 2, it's the 5-year note, 641,000. And the number 1, the big dog, the 10-year note, 1.05 million. By the way, if we kept the micros in, the NASDAQ micro would actually be number 2 at 830,000 contracts on the tape. So a lot lighting it up out there today and indeed this week. But before we dive into more of that, we have some fun to explore here on the show, listeners. It is time to dive on into a little bit of the old Futures 101.
It's time to shine some light on this mysterious marketplace. It's time for Futures 101.
All right, everyone, welcome to Futures 101, the portion of the show where we tackle some educational topic in the world of futures and explain how it works. These products, after all kind of play by their own rules of engagement. And it's not the same thing as people who are coming to this world and they're used to, let's say, trading the S&P as a SPY ETF, or perhaps trading shares of Apple or Nvidia, all one price, all very straightforward. The world of futures, a little bit different. And Brad, I think the first time people really may encounter that is the subject of our Futures 101 today, when they're going back and looking at charts and data and doing some research on the futures market. You start looking at that and you start going back over time, an obvious problem crops up, which is, listeners, these are, at the end of the day, these are futures. They have an expiration date attached to them. So they have a lifespan, a limited lifespan. So if you're looking at, let's say, the front month WTI future, for example, and now you go back 6 months, what contract is there on that chart, especially if you're at the end of the month, you're at the beginning of the month? What are they looking at? Is it just a chart of front month? Is there something else? And also, what happens when those contracts roll off the board? We see this sometimes on our TWIFO show when we talk about our movers and shakers on the week, and we see some surprising movements week over week when there's not really much else going on in that complex. Usually that means there's maybe a little bit of a hiccup in the data. And that's what we're going to talk about today, how you can go out there and really come to grips with looking at data for these futures, because it's not as easy as it sounds. Luckily for you, we have Brett joining us on the show today, and he wrote a whole article about this exact topic called Futures. Not all price series are the same. So, Brett, I kind of just laid out the broad strokes, but let's get into brass tacks. Let's get into the details. Explain your article to our listeners and some of the takeaways for them.
Sure. To begin, I'm not sure whether this is Futures 101. This is more like Futures, the seminar, where you have, 101 with a professor and no one really does anything. But basically, there's a few different ways to deal with long-term futures charts, and people don't really delve into them too deeply. They take it for granted. Like when you open the Wall Street Journal and you look at the online and you look at the long-term charts, again, as you said, what exactly is that? Is that just the front month only, or is that some mixture of contracts or whatever? Well, it's not that clear, and there's a bunch of different techniques that institutions use when they construct a long-term futures chart, and what publications do. By far the most common is front month only. So you have a December contract. When it rolls off on whatever date, the next day you'll see the January contract, and you'll see a price change because each date each month doesn't necessarily trade the same as the other months. So you'll see a gap sometimes, and what that gap can mean is that when you're calculating the volatility or how volatile are these contracts, you're going to see when the contracts roll over, you're going to see this gap, which is going to increase the volatility, which is not necessarily what you were looking for. It could be fake volatility. It's not like they were trading and moved it from one price to the other. It's as if they changed contracts. So I must say that the most important thing when you're constructing or using someone's continuous futures chart is to know what you're looking at and know what technique they're using. Because the next technique is widely used by institutions when they're calculating risk limits, et cetera, when they're using the long-term futures price charts to calculate volatility, which goes into their limits, which goes into their metrics and everything else. And that's called a continuous futures series. So what a continuous futures series is, it simulates like a 30-day futures. So every day that is 30 days out. So what they do is they calculate the amount of the days to expiration for each contract. And then they basically interpolate to 30 days. So the nearby is 7 days. For example, the nearby is 7 days. The next one is, 23. The next one after that is like 45 days to expiration. And then they have prices for each one of these contracts, and they interpolate to a 30-day contract. The next day, they do exactly the same thing. So you're always looking at the same maturity. You don't have you don't have the price changes from the contracts getting nearer and nearer to expiration, since you're holding it stable at 30 days. One of the reasons institutions do this is to get out of that fake volatility, I put that in quotes, that's coming from the expiration itself. So you have the nearby contract expiry, and you might get a gap to the next day. This technique eliminates that. And that's why institutions tend to go for that. But it really, it introduces all sorts of other problems in that you get rid of seasonality entirely with this, or not entirely, but mostly. So the individual characteristics of each contract is kind of muted, and volatility is reduced as a result. So, but those are the two, front month only and continuous futures series, are the two main ways that institutions put together long-term charts. And as I said, it really depends upon what you're trying to do. If you're looking at like how volatile is the front month to second nearby contract, how volatile is that spread, the front month only is the way to go, no question. If you're looking at more long term, we're putting together a limit series or something like that, how big should the trader's limit be? Then they usually go with a continuous futures series instead. Neither is perfect, honestly. And often they judge individual contract months using a futures price series that isn't necessarily the best one to use. They just automatically do it. So my two takeaways, if you're going to listen to anything I say today, it's know what you're looking at when you look at a long-term futures chart, and know which one is best for the thing that you're trying to do.
Yeah, people might listen to this and say, who cares? It's just the futures data. But first off, it's fundamental to the trading of the product. If you can't figure out A, what you're looking at on the graph, and B, if it's difficult to determine where the product is actually trading, that's a problem. B, of course, as you mentioned, especially for the continuous product over there, the 30-day continuous methodology, you're right, that does smooth out some of the seasonality, which is a huge component of, like we were just talking about, nat gas. Nat gas is one of the most seasonal products on the board. Obviously, it's bid up in December and wintertime. It's not as useful, not as in demand, usually in the hot summer months. Ag, same deal. They have different planting and harvest cycles. So seasonality is a key component of those products. If you're muting some of that, you're taking away a key trading dynamic. And if you want to just see for yourselves, listeners, the importance of choosing between the two and choosing the right way to analyze your product. You have two great visuals in your article here, Brett, and I encourage, again, everyone to check it out for themselves. It's called Futures. Not all price series are the same. I believe you can find it over there, our friends over there at OptionMetrics. And if you look at this chart, you picked a good one, Brett. I'll give you points for that. You picked a good chart because there's a good data point in here, which is, of course, our old pal WTI, aka crude oil. Going back to 2005, you look at these two charts. One is, of course, the, let's say, more traditional front month only methodology. And the chart has its peaks and troughs. One very notable trough, obviously, April of 2020. You can probably guess that one, listeners. And then you look at this continuous methodology, the 30-day continuous methodology. And the chart looks similar, but I think the best way to describe it is it's more muted. The peaks are not as high. It's really kind of a more muted chart, which again gets back to what we were just saying. It kind of mutes some of the unique individual characteristics of the product, which is why you're trading that product at the end of the day. And most importantly, the seminal data point on this chart, one of these seminal data points in the history of futures trading, listeners, April 20th of 2020. We all remember what happened then, right? Crude oil went negative for the first and thankfully right now only time. And again, looking at these two charts, you can see a very stark difference between the two methodologies. If you go front month only, which remember, this was an issue with the front month. If you go to the second month, it wasn't anywhere near as dire. Front month only, that chart settled out at negative 37.63. So you're pushing negative $40 on that chart. The constant maturity 30-day chart only got down to never even got negative, $20.60. Again, it's because that second month never went negative. So a very different beast that, if nothing else, highlights the stark differences between the two methodologies. Brett, anything to add here on how if you're choosing one over the other, you may miss out on seminal data points like this?
Again, it really depends upon what you're trying to do with it. But you're right. I mean, the negative day in crude oil was, I've been trading a long time, probably too long. And that was the craziest day I've ever experienced in futures or anything else for that matter. And to look at a continuous chart that doesn't have that information is profoundly misleading. It really is. Now, you can get into the argument of whether the negative prices were really valid, et cetera, but then you're massaging the numbers more than you probably should be. The fact of the matter is it did settle negative, and it should be reflected in your analysis, whether you like it or not, whether you agree with it or not. So as you can probably tell, I'm not a giant fan of the continuous futures series, but I recognize its use in certain regards, and that is, when you're putting together limits for traders, if you produce charts that are too volatile, you tend to overestimate the volatility, and you tend to give them limits that are just too tight. So therefore, that's why a lot of institutions use it. And it also, there's a lot of data involved. So, and the last thing I would say is that a lot of institutions use it for sort of a psychological reason, and that the quants love complexity. They hate simplicity. And to them, the front month only is just simple. And therefore, let's go for a continuous futures chart. We have interpolation, and we can manipulate how we're interpolating the prices and all this other cool stuff. But at the end of the day, I think it's kind of misleading, frankly. So.
But Brett, if things were simple, the quants would be out of a job. So they have a vested interest in keeping things a little bit obtuse, a little bit arcane.
That's exactly right.
So the takeaway, I think, for a lot of our listeners who are coming to this show, most of whom are going to be on the retail side, you would say is keep it front month only, and make sure when you're looking at charts and data in the futures world, make sure you click on that legend, click on the information about the graphs, exactly what you're looking at. Is that the two takeaways, Brett?
Yep, that's exactly it.
By the way, back in April of 2020, I know I had a lot of people hitting me up. I'm sure you did as well that day. Oh, the front month's a nickel. I should buy a ton of these. What's the worst that could happen? I think we all saw it can get to negative $40. They're pretty darn close. So yes, a day that will live in infamy, listeners. But you know what never lives on in infamy? It's your questions. Let's wind it up with a little bit of the old futures free-for-all.
Ring the bell. It's time to take on all comers in an epic Q&A battle royale. All questions can enter, but none can leave without an answer. It's time for the Futures Free-for-All.
All right, everybody, welcome to the Futures Free-for-All, the portion of the show where you folks take the reins, your questions, your comments, your insights, your pearls of wisdom. We got a good one this week, a very nuanced one. Again, we're talking about a lot of the devil in the details in the futures world this week, listeners. This one comes from Ian Wagner. He says, really loving the new futures rundown. Thank you for adding that show, ! Well, you're welcome, Ian, and all the others out there who are really enjoying the show. Thank you so much for listening. It means the world to us. I should have launched this show earlier. I resisted. It's on me. Blame me. I resisted for years. People kept coming up to me, firms and listeners, you should do a futures show. And I said, I don't know. Is the demand really there? Well, clearly the answer is yes. So I apologize for making you wait so long, but now it's here. Thank you for taking the time to listen and to write in. He says, my question is about futures options. We're going to the options side. Daily settlement and when the contract cease trading. Can you give an overview of how settlement works for crude and nat gas versus the major equity indices? For example, I think WTI and nat gas stopped trading at 2:30 p.m. Central, but do they settle at that time? I believe the E-mini and the NASDAQ and the Russell 2000 stopped trading and settle at 4 p.m. Central. Thanks. A very nuanced question. I was going to save this for tomorrow's futures options show, and we may delve into it a little bit there with Carly as well. But Brett, you said you had some insights you wanted to share with our listeners on this. So by all means, sir, the floor is yours. Another devil in the details question, sir, about energy contracts versus equity on the options side. When do they actually settle?
Great question. And usually people say that when they don't know the answer to the question immediately. The last trade in futures are not on the day that the options expire is not necessarily the settlement. It goes to the settlement committee, and that settlement comes out. It's not necessarily the last trade. So if you get on the CME website, there's lots of information on how exactly the settlement is produced. It's different for different strikes. At the monies have different, with significant volume, have a different settlement procedure than deep out of the monies, which don't necessarily have any volume associated with them. Then there's an assessment of the settlement, not necessarily where it traded. So because it didn't trade. So, but the at the monies are trading. So there's a settlement procedure, which frankly, I'm not totally sure what it is, but I know that there's a procedure, and I know it's very well outlined on the CME website. But it's the day of the settlement of the options expiration. There's no, like in, I believe, the weekly, I'm not going to comment on the equity options because it depends upon the expiration, whether it's the weekly expirations or the monthly expirations. I believe the monthly expirations are settle the following morning, so they expire on Thursday and they settle on the following morning, whereas the weekly options settle the same day, I believe. So, but I could have that backwards. But futures and options on futures are fairly straight. The information on how to settle them, how they are settled, is available in the CME website. One of the ways that this becomes complicated, or why it's a great question, is because often in out-of-the-money options, the question is how to settle it. So you have a deep out-of-the-money option, let's just say in crude oil, it's trading 4 bid at 8, and hardly anyone's trading, right? And you would think, where do I settle this thing? You would think it's probably going to be 6, right in the middle of the bid offer. It might not be. And this is crucial because a lot of people who have these options on the books, the settlement is used for their mark to market on a daily basis and all their margin calculations. So this is a pretty big deal. So, but what makes it an even bigger deal and why this is an important question is, let's say they settle that thing at 6, right? And it's 4 bid at 8. 6 is not necessarily where you can trade any sort of volume. So for large institutions that have large amounts of volume on their book of out-of-the-money options, and they're mark-to-market at the settlement, that's not a liquidation price. So if they have like 5,000 of these suckers on, and they're valued at 6, really it's the bid where they're probably going to be getting out or below. So they have sort of a shadow loss on the book, which isn't really recorded. That's why you see people arguing, institutions sometimes arguing vociferously about that the settlement is incorrect and you should change the settlement. The people who are on the settlement committees, that's a bad job. You see, you're constantly getting yelled at.
It's like being an offensive lineman in football, right? All you can do is cause penalties. You never get a pat on the back. It's always when you jump off sides. Again, this is kind of the theme of the episode, listeners. The devil is in the details with a lot of these products. We will tackle this question in more detail tomorrow on This Week in Futures Options because it is a futures options oriented question. I did want to bring it up here because Ian did reference the show and because Brett had some thoughts. But that is going to do it for us on the futures rundown for this week. Man, we were all over the place. A fun, far-reaching show, very nuanced this week, which again, if you're going to come to grips with the futures markets, you need to understand these nuances. We don't mean to intimidate you. We don't want to put you off. We want to inform you so you're not as scared. You're not as intimidated by these markets. And when you see this data out there, you know exactly what you're looking at. And Brett, if folks want to check out your article for themselves, where should they go? What should they do?
Get on the www.OptionMetrics.com, or you could find my more retail-oriented articles on Option Strat. www.optionstrat.com. Both of them have my articles.
OptionStrat.com. I'll have to check that one out. Intriguing stuff. And this particular article we were referencing on the show this week, again, listeners, it's called Futures. Not all price series are the same. And of course, you know where to go if you want to check out everything that's cooking over there at CTS Futures. It's just ctsfutures.com. Click on their T4 futures and options. You can sign up, check out all their platforms. It's not just futures, they do have options as well. So if that last question intrigued you about the world of futures options, they got you covered over there as well. ctsfutures.com, the place to go to learn more. That's going to do it for us on the network today. Back again tomorrow with a special doubleheader. First off, we'll be kicking off with our friends over there at CBOE. The Flowmaster will be beaming in from the CBOE Risk Management Conference, so should have some interesting updates about all the latest and greatest in the world of volatility on that show and the latest risk management research. Always a great event. It should be good to hear from him. Beaming in from, I believe they're out in Utah this year. And then after that, we'll be coming back with This Week in Futures Options with our good pal, Carly Garner. I got a feeling we're going to touch on that question here in a little bit more detail and a whole bunch more. Friday, of course, volatility views with our buddy Dr. Vix. He'll also be coming back from the Risk Management Conference. We'll see what his thoughts are on the event, as well as everything else going on in the world of volatility. And then we wrap it up for our pro folks, theoptionsinsider.com/pro, with a little bit of the old options oddities. And we're back again next week, all the way through to next Wednesday, and another episode of the Futures Rundown. Stay safe out there.
Thank you for tuning in to the Futures Rundown, proudly sponsored by T4 Futures and Options. Experience the T4 Futures and Options trading platform with its seamless desktop and mobile applications, low latency, and professional functionality tailored for traders and brokers alike. Take advantage of T4 theoretical sheets, strategy solver, MBO, advanced charts, and much more. Empower your trading journey with T4 Futures and Options. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.